Hi, I'm Kira Hayes,
I'm Ari McKinlay.
I'm Anson.
and we will be discussing the cross rates between the Australian dollar, the British pound, and the Australian dollar and the US dollar.
It is believed that the cutting of interest rates depreciates the currency due to the discouragement of capital inflow, reducing the demand for the selected currency, increasing supply in the foreign exchange market. The appreciation of the AUD, especially against the USD and GBP, has been attributed to Australia's maintenance of relatively high interest rates in comparison to the other major economies. However, expectations of the RBA to cut the official cash rate throughout the remainder of 2016 and following into 2017 leaves the impression that the AUD will continue to depreciate following the trend from 2013. One of the RBA's main objectives is for the target of consumer price inflation to be between 2 to 3% in an attempt to perpetuate the economic prosperity and welfare of the people of Australia. On the 6th of September, the RBA held the official cash rate at 1.5% in response to low levels of underlying and headline inflation. Indicated by the ASX 30-day interbank cash rate futures, there is an expectation of 5% that the cash rate will decrease to 1.25% on the 4th of October. The RBA's slump forecasts of lower than expected GDP growth see depreciation in the AUD and a further cut to the official cash rate to 1.25% in the November after the release of the new CPI due 26th of October in an attempt to stimulate economic growth. The expectation is endorsed by Workman of the CBA, Davies of ANZ, Olivia of AMP Capital, Haslam of UBS, and Kerr, a CBA senior interest rate strategist. According to Spivak, with the US economic data described as underperforming in relation to last year's expectations, the announcement of the FOMC monetary policy has a 20% probability of an interest rate hike, causing the AUD to depreciate further against the USD, due to the direct effect on the relative yields outlook. US is currently operating at near full employment with low inflation and low wage pressures. It is expected that the 30% fall in the AUD-USD over 2013-15 period will continue to depreciate further, particularly due to the lack of demand for Australian commodities and the movement from mining sector exports to soft services like education and tourism. Following Brexit, the Bank of England has coordinated with the European Central Bank to exercise extremely accommodative policies, cutting the bank rate from 0.5% to 0.25%, with the expectation of a further cut to 0.1% in November, fluctuating between 0.25% until late 2019. The known risks of the European economic condition, the devaluation of the USD predicted in the next quarter, both the AUD and GBP described as risk-correlated currencies, predicted deflation, and the deterioration of commodity and oil prices see depreciation of both the GBP and the AUD as inevitable, causing the pair to trend flatly and depreciate.
When showing changes in inflation rates in the coming two quarters from figure 1, it is expected that US inflation rate will decline relative to that of Australia, after which it will remain lower than that of Australia. The rate of inflation of a currency affects the exchange rate and the value of the country's currency. Normally, when the inflation rate of a country's exchange rate depreciates. In this case, for the US dollar Australia pair, the decline in inflation rate of US relative to that of Australia implies that US dollar will strengthen against the Australia dollar. In the United Kingdom, the Office of National Statistics reports that the interest rate in the nation is 0.3, 0.4 and 0.6% in May, June, and July, respectively. Comparison of the two currencies shows that the inflation rate is beginning to decline in the United States, within currency. In Great Britain, the rate is increasing, it is expected that in the next 6 months, the Great British inflation rate will have surpassed that of the United States. This indicates that the export from the United States will be more competitive than those from Great Britain, and thus will be an increased demand for the US dollar to purchase goods from the United States. Figure 2 showing changes in growth rate in the coming 2 quarters. Growth rate of GDP also affects the exchange rate, whereby as the GDP of countries grows, its currency appreciates. For the US dollar Australia price, it can be seen that the GDP growth rate of Australia will remain relatively stable over the next 3 to 6 months, but that of the US is projected to significantly increase. This implies that there will be a higher relative growth in the GDP of the US. As a result, the US dollar will strengthen against the Australian dollar. On the other side, the United States has 1.1% increase in the gross domestic product between January 2006 and July 2006, and the United Kingdom only had a 0.6% increase in its GDP. The economic growth rate of the United States is higher than that of the United Kingdom. As a result, the demand of the US dollar would be greater than the demand of GBP, leading to the appreciation of value of the US dollar relative to the GBP.
Government intervention affects the exchange rate in many different ways. The Bank of England is owned by the UK government, which is how they intervene in the foreign exchange market. The bank promotes stability in the UK dollar and the financial system. Global events are often one of the main factors that can influence the exchange rate of various countries. Brexit is the name given to the withdrawal of the United Kingdom from the European Union. The process began on the 20th of June 2016, after 51.9% of the population voted in the referendum to exit from the EU. Since that day, the UK has experienced a currency crash, defined by Carmen Reinhart and Ken Rogoff of Harvard as any drop greater than 15%, as the pound dropped dramatically from its peak and has gone from a peak position of 1.9694 on June 20th to a low of 1.6774 on Monday the 15th. The sterling dropped 10% overnight following the Brexit announcement and a further 8% by the end of the next trading day. A drop of this proportion has not happened since 1967. The government's plan of pumping £250 billion into the money supply can only appreciate the AUD GBP from its current low of 1184. By government intervention, the Bank of England and the United Kingdom's government's plan to pump this money in, which is the equivalent of 460 billion Australian dollars, into the British markets in an attempt to keep them stable and steady, but also ensures that the repercussions of Brexit on the UK's economy, the EU's economy, and the rest of the world is as minimal as possible. We predict that from this point in time, after the massive drop in the pound, that it will continue to depreciate and hold a steady but low value against the Australian dollar. We predict this mainly on the basis that Brexit is a 2-year process, and whilst the government and the Bank of England have plans to pump this money into the money supply, it will be a long process and a long time before the money enters the money supply and circulates the economy. The role of the US exchange market is a little different. The primarily financial responsibility of the stability of the USD and the US foreign exchange is allocated to the US Treasury, but they work in consultation with the US Federal Bank. The intervention process works by using foreign currencies previously held in the Federal Reserve's holding and the Exchange Stabilization Fund of the Treasury to ensure stability in the US dollar. In recent years, the US government has held back in intervening in the natural progression of the dollar unless there have been major national or natural disasters. For instance, one fairly recent example of government intervention occurred in 2011 when the US Federal Reserve bought $1 billion back after the March earthquake, after fears that the yen would surge, and it was to offset any instability within the currency exchange. However, in relation to the AUD-USD, there have been very limited intervention, as there are solid expectations that there will be no surge or crash of either currencies. We predict that there will be an appreciation of the USD against the AUD, mainly because that is the general trend that the two currencies are currently projecting. The expectation that the AUD and USD will depreciate may actually cause the depreciation. If market participants, namely those being the federal banks and the US Treasury, expect a steady depreciation of the AUD-USD, it will most likely manifest from subsequent market activities with this in mind.